Why does this always seem to happen on Fed Day? Okay, get this. Fed head Jay Powell takes the podium at about 2:30, says a couple good things like the central bank's going to bring the inflation rate down to 2%. Okay, that's a good thing. 0 would probably be better, but let's cut him some slack. 2%, that's the global worldwide target. And markets rally. Everybody knew he was going to raise the target rate a quarter point to 5.5%, which, by the way, I think historically is a good number. But then Mr. Powell talks, and then he talks and talks and talks some more, and that's when stock prices and everything else start gyrating wildly, mostly because folks don't know what he is saying. It's like, what does this guy mean? What is he talking about? Sometimes wages are too high, then they're not. We could have a soft landing, but maybe not. We might have to raise rates more in the future, or then again, we might cut them. We need higher unemployment. No, we don't. I mean, really, the more he talks, the less sense it makes. He does it all the time. He is a single-handed volatility producer. At one point, he said we don't see inflation coming down to 2% until 2025, and the market sold off about 200 points. Then he said something else, and the market came back. Who knows? You know, I yearn for the days when Paul Volcker would blow cigar smoke at Congress and basically tell folks nothing. Nothing. That's what a good central banker ought to do. Make it a surprise. Tell them nothing. Keep them guessing. Now, here's a thought about today's story. Keep your eye on gold and oil. Gold's a classic inflation indicator telling you whether the dollar is fundamentally strong or weak. Gold was $1,600 last November, and today it's just south of $2,000. All right, I don't know. It was up $11 today after the Fed rate hike announcement. Maybe this is why the Fed keeps raising their target rate. It's not a great sign for future inflation, this big gold rally. Oil, meanwhile, is up about $10 more or less from 69. It's up to 79 bucks. Some people think it's going up another 10 to 15. If so, that would raise the top line CPI, as David Bahnsen told us the other night. I'm being overly simple here, but you could do worse than just tracking gold and oil as an indicator of interest rates and inflation and Fed policy. They won't say that, but that's kind of what happens. Another point I'd make is the Fed's so-called balance sheet, which is basically the portfolio of government and mortgage-backed securities they own, is still too high, okay? Still too big. The peak was $9 trillion during the pandemic. It's dropped toward $8 trillion. But you know what? It was about $1 trillion not long ago. And I think the reason gold is still historically very high is that the Fed owns too many bonds and has printed too much money, even though it has printed a bit less new cash than before. Another point to make is the Fed should not be targeting the unemployment rate or wage rates or the number of people working, or their job is to keep an eye on money and prices. That's what they do. Not about the economy. If you're worried about the economy, that's a function of fiscal policy. That is spending and taxing and regulating. Now, the Biden administration has done way too much of all three. So while jobs have recovered from the pandemic, wage rates still underwater from high inflation, which is 16% above February 2021. That was Mr. Biden's base month as president. Grocery prices up about 20%, energy up about 30%. The Fed was late to the party. Now they're catching up. Yeah, the real interest rate on two-year government paper is almost 3%. That's good. But the real yield on 10-year Treasury is only 1.5%, which is not good. It anticipates more stagnant economic growth and diminished capital formation. If Jay Powell had a backbone, like Volcker and Alan Greenspan, he'd be out there telling Congress to stop spending. He would suggest that limited government would grow the economy from the supply side, and that would bring down inflation permanently because you'd have less money chasing more goods, which is the right policy mix. So the Fed should quit trying to control interest rates, just reduce the size of the balance sheet, stop printing new money. The Congress should spend less, tax less, and regulate less. For this, we'd kind of need a new cavalry, wouldn't we? Actually, we'd need a whole new army, all right? Anyway, let us give Bidenomics the burial it so richly deserves.